Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very, very excited to be here today. Coming up at the end of April, it is the NFL draft day for round one for all NFL fans. As I have to start with that real quick, obviously I'm a huge Bengals fan. They have the 18th overall pick, assuming they don't move that either up or down. They haven't moved up in 25 years. They still have scars from taking Kajana Carter, who didn't pan out well.
Did his best.
We'll just see what happens, man. I'm super excited though. It's going to be a fun night.
Yeah, it certainly is a spring holiday for many folks. Looking forward to it.
Yep. So it's going to be great, and very excited to be here today. A ton to talk about. So I'm going to kind of dive right into it today, I know you just got back from a cool trip out to LA and then Hawaii, but welcome back to the Bluegrass State, man.
Thank you. Happy to be back home for me.
Yeah.
So.
Yeah, that's absolutely coming up on Derby Day too. So your timing is perfect. That's a completely get me excited about doing a podcast. We can talk about that, maybe in the next couple of weeks here.
Yeah, I'm looking forward to the block parties, but not so much anything else around Derby. So.
Absolutely, we got to talk about the outfits everybody's wearing too. So that's coming. But yeah, a ton of stuff happened here. So wanted to start out with a real quick question. Part of the reason why we do the show, real quick, for those that are watching for the first time, welcome. Hit the subscribe button, hit the little notification bell. That way, when we drop these things on YouTube about every 2 weeks, you're up to speed on what we're doing here. But why we love the show, why we get a lot of good feedback from our customers, and even those that aren't customers, but just enjoy what we're putting out here from a content perspective, is we're going to talk about a lot of things that are going on in the news today. The news does a great job of letting you know what the issues are, the things that might be worrisome, the things that might actually get you excited about being a participant. But the one thing we do know about the news is they tend to try to placate to human beings' emotions. We're all hardwired with this thing called fear and greed, going back to the beginning of time. And one thing I think that the news does a good job of understanding is human behavior. And behavioral finance is an actual subject you can get a PhD on. And in a nutshell, what you learn from that is that human beings are hardwired with those emotions, fear and greed, which means we actually feel losses twice as much as we feel good about a gain. So the news typically placates to that fear side of humans, given that we feel those losses twice as much as we feel good about making a gain, which keeps eyeballs on the screen. That's why they do that, so they can sell ads. That's their business model. There's nothing wrong with that. One thing I wish that they would do a better job of is providing investors and viewers historical context. This is never usually the first time we've been through something. And once you have a good understanding of what human beings have done under very similar circumstances, it doesn't guarantee a future result, of course. Investing always involves risk, including risk of loss, but at least it puts the probabilities in your favor. That way you can go about building an allocation around some of that historical precedent of what humans have done in the past over similar circumstances, and what the results actually became for various asset classes in the overall market over a 6, 9, 12-month period of time. So that's why we do the show, is to provide you guys with that historical data. And we're going to talk a lot about that today. So what is some of the headline news? We're going to get right into it. I'm going to share my thoughts about it, but also to provide some historical context to it. So you are a more informed individual investor to make hopefully more consistent, profitable decisions for yourself. So with that being said, we kicked off earnings, and earnings in general, very, very good. So let me just get you the numbers here real quick. So from an earnings perspective, looks like about 80% of the companies that have reported so far have beaten their earnings expectations. And it looks like we have 158 companies reporting this week alone, which is about a third of the S&P 500. But of the 155 companies that have reported so far, which is about 31% of the market, 80% are beating. And the median beat rate is 8%. So extremely healthy numbers here at the very beginning of earnings season. But there is a sore thumb that's sticking out in the market here today. That would be Meta, or otherwise known as Facebook. And the funny part is, it's not so funny when you look at the stock price here, but I'm gonna make a little case here. Is the stock is now down somewhere around 10% as I'm sitting here delivering today's podcast. It was down around 14% to start the day. So I'm actually watching the screen here that's in front of me. in my office to see if I can get a quick update for you guys as I'm delivering this information. But Meta actually doubled. They doubled their earnings from a year ago, and the stock is selling off, substantially here based on some of the guidance that they provided. So let me provide some context for this. Meta earned 12.37 billion in revenue for the quarter, this past quarter. That produced a $4.71 per share earnings per share result. And this is up from 5.7 billion or $2.20 per share over the same period of time a year earlier. All right, so they did 5.7 billion last year at the same time. Now they're at 12.37. They doubled their earnings, both on a revenue and per share basis. Revenue actually rose 27% to 36.46 billion. That's up from 28.65 billion just a year ago. And analysts were only expecting $4.32 per share on revenue that was a little more than 36 billion. So again, Facebook, Meta actually delivered fantastic earnings results, but the stock is being sold off right now due to the fact that the CEO, Mark Zuckerberg, has decided to increase some of their CapEx spending on artificial intelligence, specifically NVIDIA chips. To be very frank about it, that's NVIDIA's biggest customer is in fact Meta or Facebook. So they're going to spend a little bit more on the artificial intelligence programs that they're building out, and that's to target ads a little bit more effectively. It's just to basically have a more efficient business. And Zuckerberg came out and said, not only are we going to do that, but this is going to take some time, maybe a year or so, maybe a couple years, before we see the type of revenue growth and margin impact. And speaking of margins, their margins actually increased as well. So the margins were up over 28%, which was, I think, a record for Meta as well. So fantastic earnings. They're spending some of those earnings on their own business to make them more efficient, more profitable for the future. And that's always actually, in fact, worked out really well for Mark Zuckerberg, his team, and all the shareholders for Facebook and Meta over a long period of time. And if you actually look at the long trend chart of Facebook, you're going to see that the uptrend is still intact even after a major sell-off like today. So I do not get too anxious when I see something like this, specifically for a company that just doubled their earnings over a 12-month span of time. So that's our take on that. I have no idea why the news isn't actually saying, hey, they doubled their earnings and all these things that investors generally would be extremely excited about. And to be completely honest, I expected this. I bought additional Meta shares for customers leading into earnings because I did expect the profitability to be better than it was year over year. And we were right about that, but we were certainly wrong about the timing of the purchasing of the shares, given the way that the street actually took the analyst call, with Mark Zuckerberg and the CFO. So interesting way to start the day here, but for some reason, the doubling of their profits and earnings wasn't really mentioned at all today. This isn't too surprising, right? I mean, almost in every scenario where you got a company that's expected to deliver great earnings, they typically do, and then kind of see a little bit of a sell-off the next day. So that was unfortunate for shareholders of Meta here, but the long-term prospects still look fantastic. So on other earnings news, another holding that we have here for customers, we're very bullish not only on technology as a sector, but also industrials. And one of the largest industrial players is Caterpillar. Caterpillar reported earnings per share of $5.60 from sales of $15.8 billion. The street was looking for earnings of $5.14, so they beat on the earnings per share. Sales, though, the analysts were expecting $16 billion, so that was slightly lower than what analysts had expected. So they actually improved their profit margins. So again, they sold a little less than analysts expect, but they were more profitable, substantially more profitable than analysts had expected. And their operating profit margins improved to 22.2% in the first quarter from 21.1% over a year ago. So again, fantastic earnings, but Caterpillar is selling off about 7.5% last I checked. Again, I'm checking all these positions as I'm delivering this data to everybody here today. But you're seeing some of these really well-known, highly respected, some of the best companies on the planet, quite frankly, deliver fantastic earnings results, but their share price isn't actually telling you the full story here. So again, I take all this stuff with a grain of salt. A lot of the sell-off in Caterpillar, to me, based on what I'm looking at, is the fact that the stock is already up over 20% year to date, delivered great earnings. You're seeing the shares fall here, as I just mentioned. I think it's just a little bit of profit taking. I think some people are just concerned that Caterpillar, being an industrial, a big industrial player, their stock has moved that much so quickly here to start the year. But to me, that's not a great reason to go about, selling shares. So we're a big cap fan here. Caterpillar, not the Kentucky Wildcats, although go Cats.
Yeah.
Completely different type of conversation.
Totally different convo.
Completely different program coming up next year too, for those guys. But just some headline news here for big earnings announcements, and I don't think that they're necessarily telling you a very good story if you're just looking at the share price here today. So that's some historical context for those, and we are holding those positions. We may add to them after we let the dust settle here, because we have some other really big earnings announcements later today. After the market closes at 4 o'clock, we have Google, otherwise known as Alphabet, producing their earnings after the close, 4 o'clock. Very excited for that. I do expect that to be fantastic. Much like Meta, Facebook had fantastic revenue. A lot of the revenue comes from selling ads. I mean, that's their primary business.
Yeah.
Google has all kinds of stuff. They make money is by selling ads. So being Facebook is really good there. I anticipate that Google is. I mean, if you're a bigger company and you're going to do a advertising campaign, you're likely going to spend the money in one of two places or both, and that's going to be Google as well as Facebook, just given their audience. Like, Facebook has 3.25 billion active users on their platform every single month. I looked up the world population. The world population is 8 billion. They nearly have half of the population on their platform. Hence the reason why, if you're going to do a marketing ad campaign, you're likely going to use Facebook, and you're certainly going to use Google. And they're spending money on artificial intelligence to make their targeted ads more profitable for those businesses that do an ad campaign with them. So I completely understand the reason for building out that infrastructure, because it is expensive. None of the stuff with artificial intelligence is cheap, nor should they be cheap if they're going to implement an effective artificial intelligence strategy for their business. So very excited to hear what Google has to say, but we also get Microsoft after the close as well. So two huge tech players hopefully deliver some fantastic earnings and even better guidance. And I think that we'll see quite a bit of a turnaround here, because not only do we get all that, but all that leads into Friday morning at 8:30 this week, where we get the Fed's favorite measure of inflation, that is known as core PCE. Street's looking for a number of 0.29, so anything at or below that would be fantastic. So we're looking forward to Friday morning as well. So all kinds of stuff has already happened, but a lot more is about to happen. We have a third of the S&P reporting just this week. So obviously we have a lot more earnings to get to over the weeks to come here, but this is a huge week. Because all this also leads into May 1st, next week. Fed Chair Jerome Powell is going to make an announcement on May 1st regarding the economy, employment, interest rates, their thoughts on potential rate cuts, and so on and so forth. So we're going to get the data coming up here over the next several trading days. Now, with all that being said, the interesting news that I wanted to bring to the table today is regarding some of the CPI data that we've already actually received. And we touched on this, and we'll continue to touch on it because it's such a hot topic these days, giving the change of what the expectation is for potential rate cuts later on this year. I thought that this data was unbelievably important, and I have not seen it in the broader news anywhere. Not on CNBC, not Fox News, CNN, you pick your favorite news channel. I haven't seen anybody talking about this, but I thought that this was very, very important for people to kind of understand here. This is going back to 1970 all the way through today. The median component of core CPI, meaning that of all the things that they use to calculate CPI, you have two huge ones that we've talked about that have kept the CPI number elevated. That would be auto insurance. I have some data on that. Shelter, I have some data on that. Those are the two major components that make up the bulk of the CPI calculation. So if everything else, let's just call it other core CPI data points, the median component of core CPI is actually at 1.76%. This is below the long-term average for core CPI components and the core CPI component long-term average from 1982 to 2019 is 2.4. Now, why do we use 1982 to 2019? Well, in the early 80s was the last time we had a substantial inflation issue that we were trying to deal with. Okay, so the average being 2.4, and we are currently at 1.76. That fully explains the huge weight that shelter and auto insurance actually plays into the CPI calculation. Let me give you the data here, Ez. So auto insurance inflation is up 22% just this year. From 1982 to 2019, same period of time we were just talking about, the average auto insurance core services CPI piece for auto insurance, the average is 5.16. All right, right now we're at 22%. It's going to take time for all this auto insurance premiums going by state, because this is all regulated through the individual states themselves. So if you're an auto insurance company and you want to raise your premiums, you got to go to every individual state, ask for the right to increase your premiums for auto insurance. You got to back all that up. All this stuff takes time. Auto insurance being up 22% on the inflation. Again, the long-term average is 5.16. That's going to come back to its long-term average. And as soon as that does, core CPI, all the CPI components that we're looking at for inflation, it's just going to fall off a freaking cliff, right, when that actually does happen. Shelter, the other major component of inflation, the core CPI. Shelter is up 5.65% year over year. The long-term average from 82 is 3.37%. So just looking at those two components, you can easily see why that's keeping the headline CPI number, the headline inflation number that everybody kind of wants to pay attention to, extremely elevated. If you look at the core services, like the actual core services component of CPI right now as we're talking is 5.4%. The long-term average for that is 3.59. And finally, the other core services, so everything except for, strip out auto insurance, you strip out shelter, and we just call everything else other core services. Right now, it's 2.92. The long-term average for other core services is 3.89. So we're actually below the long-term average for everything else in CPI except for auto insurance and shelter. So my point being is that the market is way too pessimistic about the path of inflation. They're way too pessimistic about the potential for rate cuts later this year. I mean, I'll give you the data. On January 12th this year, 2024, the Fed funds futures was looking for 6.7 rate cuts this year. By March 22nd, 2024, that fell to 3.4 cuts. And as we're sitting here talking today, that is now at 1.7 interest rate cuts. Now, to be completely frank and honest, and we've talked about this in prior podcasts, you don't have to take my word for it. You can just hop on our website, shepherdwm.com, top of the page, will take you right to our YouTube channel, and you can look for yourself. But even if we had 0 rate cuts this year, that is still a win for bullish investors in the equity market. And the reason being is if we didn't actually have rate cuts, it would only be because the U.S. corporate are extremely strong. Therefore, the Fed doesn't actually have to do that, which is a good thing. Good news would be good news in that scenario. If we had any rate cuts at all, that would also definitely be a good thing for a lot of different sectors that we talked about, small caps, technology, industrials, just to name a couple of sectors off the top of the head here that we really like in the environment that we're in. But the reality is that the market is pricing in fewer and fewer rate cuts. Now we're going to get more data as, again, we get the latest core CPI number, the core PCE number this Friday at 8:30 in the morning. So we have more data that's going to come out. But my point really is that just these two components themselves, there is absolutely nothing that the Federal Reserve can do to reduce auto insurance inflation that's running at 22%. Nothing they can do. Additionally, there's nothing that they can do about shelter inflation running at 5.65%. There's absolutely nothing in their monetary policy toolbox, if you will, that they can pull out something to adjust for this. And they know that, which is why they're trying to be extremely patient. But to me, in my eyes, the Fed is looking for a reason to cut rates. The market just hasn't given it to them yet in the form of inflation data. So the more data that we come out here, I think the auto insurance and shelter components, which is the biggest weighting, is going to finally trend back towards its long-term averages here. I mean, this is just not something that's going to continue. And I don't think the Fed's really that concerned about it because, quite frankly, as I mentioned, there's nothing they can do to combat that with either increasing rates, decreasing rates, or keeping them the same. It has zero impact on either of those components that make up the biggest percentage of the actual inflation calculation itself. So that was the big stuff there. One of the questions that we got that we didn't get to right away, as I apologize for that. I think we got a little sidetracked with the NFL draft and your awesome trip out west.
Yeah.
But we did have this event, and I did get a question about it. It's called a Bitcoin halving. So we just had this event happen. I forgot the exact date. I want to say it was last week, just a couple days ago. But essentially, all this means is they're reducing the amount of supply of Bitcoin, cryptocurrency itself. And when you're reducing the supply, the reason why that kind of happens, it's a scheduled event. It typically is around every 4 years. But there's a finite number of coins, 21 million coins out there that can be available to be mined. It's going to take, I don't know how many years or decades before that actually is, completed.
Yeah.
I don't know if you have any context on that or not. I think it's decades.
It's decades. It's so far that I don't even remember.
Yeah, I think it's way out there. Maybe in like 2140 is a number or a year that I saw where all the coins might actually be completely mined after all the halving events that'll actually take place here. But simply just reducing the supply is kind of like a way to hedge against the inflation that could happen with a cryptocurrency.
Yeah.
And as you reduce the supply, as long as demand is the same, that should actually increase the value of the asset class itself. So that's it in a nutshell regarding the halving. So I did get a question about that. And the other part is, hey, are we going to participate in this? So I did my homework, as I usually do. And I start with history. And why do I always look at the history of things? Is because I want to put probabilities in my favor. I like to understand how human beings have reacted under similar events, like a halving event for Bitcoin. And every time that we've had a halving event in Bitcoin, you've almost always seen the asset share price increase in a fairly substantial way. And then the asset class itself is already up quite a bit. Year to date, it was the best performing asset class last year. And our way of participating in that now, which is kind of headline news in and of itself here at Shepherd Wealth Management.
Yeah.
We've been very anti, crypto investing, but how we're going to dip our toe in this asset class without actually, owning Bitcoin itself or any of those brokerages like Coinbase that, execute the transactions itself for Bitcoin. We're using MicroStrategy. MSTR is the ticker symbol. This is not a recommendation for anybody listening to the show. I only make recommendations for clients who, we've had a thorough conversation, truly understand their goals, needs, risk tolerance, etc. But we're taking a small weighting in this type of position. It is a Bitcoin miner. So they are actually mining the asset class themselves. They can hold it, and they are holding quite a bit of those coins on their actual balance sheet. But they have full discretion on what they're going to do with those coins. So that's kind of our way of entering the space. It's kind of very similar to NVIDIA, in my view, not just the share price movement, because if you look at the two charts, they're very parabolic, and they're very similar in that way. But if NVIDIA is known as the pick and shovel, in quotes, if you will, or artificial intelligence, well, what does that mean? It means that NVIDIA is making a chip that there really is no competition for at this particular moment in time. And that chip allows other companies to actually implement artificial intelligence using all the data that they have to actually implement a artificial intelligence sort of strategy for the business, whether that's cross-selling ads, making their business more efficient, etc. So with all that particular asset class of a chip is what is needed to do artificial intelligence, much as a mining process has to happen in order to have a Bitcoin. So in our view, MicroStrategy as a miner is kind of like a pick and shovel for the asset class known as Bitcoin. So that's the way that we view it. We're taking a small weighting into it, and I do expect the asset class to move up in value here as the supply has been reduced and demand, even if it stays the same, which likely will be increased, which should actually push the price higher. Now, it is one of the most volatile asset classes out there, so buyer beware. and make sure that you're truly understanding the volatility and the risk of the investment itself, which is why, again, we look at what history has to say before we go about, tinkering or adding something to an asset allocation. So that was one of the big questions that we got from that. Hopefully that makes sense. Anything you would want to add to that, as I know this is a space that you kind of follow and have been an investor in for way longer than I have.
Yeah, no, I mean, I think you covered it well. It's like the big thing is it's a hugely volatile asset class. So when it's rocking, everybody pays attention to it. And then when it's fallen, everybody wants to claim that it's dead. So understanding what you're getting into and being responsible with it is is the most important thing. The havings, along with everything that, which is maybe a different podcast we could get into a little more detail with things like the blockchain, just the general technology behind Bitcoin and how um, the people that, developed it and installed it, put in what they considered to be certain safeguards to help hedge inflation and make sure it wasn't able to be centralized into one person's holdings as easily as maybe you would expect it to be. Um, I think that's a really important thing for folks to at least get a cursory understanding of before they jump into just attempting to predict how high it'll go and when, to kind of get these really quick payoffs with it. Um, so yeah, it's, not as complex as you might think, but like I said, it's probably something that's best suited for its own specific lecture, maybe a podcast we could focus on that. Cause now that you're able to do ETFs and, participate in Bitcoin and not kind of what you would consider maybe peripheral ways as opposed to just holding the asset yourself. It certainly is a lot more enticing and more available for a lot of people to pull into their portfolio. But yeah, it's been
Yeah.
something I've been doing for years now, even before the pandemic. Crypto was something that was just intriguing to me as a concept. I made some decent money on other coins, like specifically Polkadot, before I just completely liquidated that about maybe a year ago. Um, Bitcoin now is the only crypto though that it's part of my dollar cost averaging. I hop into it every week at a specific time. So
So just check it out. If you want to take a look at the chart, as I mentioned, you can feel free to do that. And we'd be happy to answer questions. So if you guys have questions regarding that or anything else, again, just go to the website, shepherdwm.com. All kinds of ways to get a hold of me directly, phone call, text, email. Leave a comment on the YouTube page itself, which a lot of people have, and we try to get back on those comments with responses as quickly as we can. And to wrap us up here, with all the volatility that's kind of happened here, leading into this week, we've kind of seen 3 weeks of just market sell-offs. And a lot of that has to do with disappointing inflation numbers that have been printed. And some of that has also been the growing geopolitical risk between Iran and Israel. But I do want to provide 5 reasons why we do believe that this deleveraging process, the selling process that we're kind of experiencing, is likely closer to the end. So here are our 5 reasons. The spot VIX, the VIX is just a volatility index. You can call it a fear index. The higher the VIX level, the more fearful the market actually is. And they used contracts on the S&P 500, calls and puts. So the spot VIX being above 18, we actually believe that will fall as interest rates begin to flatten out and then eventually fall. So that's one reason you're seeing some volatility right now. But we do anticipate that could be seeing its end here rather soon. Specifically, if we get some really good results from some of these big tech players that are going to be doing their earnings after the bell today, and of course the big Friday announcement with the core PCE. That could change the trajectory of both the VIX as well as the overall yield curve, beginning the flattening process and then ultimately turning lower into May. If you look at the VIX, so reason number 2, VIX term structure. If you take the 4-month forward VIX minus the 1-month VIX, you're looking at it uninverting. So instead of seeing the VIX rise, if you take the 4-month VIX minus the 1 month, it's uninverting. Why is that important? It is because the last 5 of 7 times, this was a tradable low immediately. And 2 of the 7 times that this has happened resulted in further declines ahead. And that was in February of 23 and September of 23. Both of those particular instances, February of 23 and September of 23, there was a shock in the market with a higher inflation print. very similar to this year. At the beginning of the year, we had higher inflation prints. Well, we had that happen last February as well. We had a higher inflation print last September when oil prices went up. Those were the only two times when we've seen this uninverting in the VIX happen, where we didn't see an immediate recovery in stock prices. But 5 of the other 7 times, again, probabilities are in your favor here. It was a really good time to look at adding to exposure to S&P 500 or your favorite stocks in the NASDAQ or the tech sector. Reason number 3, we're seeing equity declines accelerating to a downside as a 5-day rate of change is minus 3.6%. So why is that important? As we've seen this happen in the past, this has also been a really good opportunity for picking up shares within the S&P 500 or your favorite sectors. It's very similar to our 4th reason, which is the put-call ratio hit a 1.13 number here recently, which is a sign of a tradable low. To provide some of the historical data around when that happens, we've seen this happen several times since October of 22, 7 times specifically, and 6 of those 7 times was a tradable low. I mean, it was a great time to buy stocks. The sole exception was, again, September 13th of 2023. But recall, at that time, Fed was still hawkish. Fed this time, the difference is actually looking for an interest rate cut. So really good reasons from a historical perspective to be a buyer of equities, specifically within the S&P and NASDAQ. And lastly, there's something called a breadth gauge, and the S&P 500 breadth thrust gauge has reached levels where bottoms usually occur. We wrote about this in our latest weekly blog that we send out to customers. So you can go to actually shepherdwm.com. You'll find at the top of the website, there's a section for our blog. We lay out all the charts and all the data here. But the breadth thrust gauge, which we normally look at, has reached very low levels. And this has reached the lowest level since October and signifies a very concentrated situation for market breadth. And normally, when this measure gets so low, the resulting balance can be meaningful, and we should be getting closer to that point. We can definitely put all these charts as right up on the YouTube channel itself for those that want to take a closer look at that. But again, you can certainly go to the website and check out all of that data. So we got 5 historical reasons under very, very similar circumstances as to what we're going through right now, where it's not a guarantee. There was a few moments in time there where things didn't work out when the data came in the way that it has. But I think the difference this time is the Fed is looking for a reason to cut. They just need something in one of these CPI prints, hopefully Friday's core PCE number, which is their favorite measure of inflation, gives them the confidence to begin actually interest rate cuts, hopefully sometime here this summer. So that's kind of the historical reasons why we're still very bullish. The uptrend is still intact from a technical standpoint if you're a chartist. And the fundamentals from an earnings perspective, as we've just kind of laid out here, have been fantastic, even though you're seeing sharp sell-offs for companies like Meta and Caterpillar after delivering really strong earnings. So we are not being fearful in this moment. We will likely be greedy, as Warren Buffett would say, as others become fearful. But I think we're going to learn a lot here after the close at 4 o'clock with Google and Microsoft, and then, of course, Friday morning. Now, with that, I think we've covered a lot of ground here. That was pretty much all the highlights. We went from earnings to GDP. I gave you guys some historical stuff on core CPE. The components are actually trending below long-term averages for the most part. Great earnings results. We got some data coming up here as well, and our thoughts from a historical perspective on why we were still, buying this dip. And we will continue to buy this dip until something changes with the trajectory of inflation, or if the economy becomes much, much weaker from a GDP perspective or an employment perspective. But all the boxes are being checked right now for the bullish investor, and that is exactly what we are here at Shepherd Wealth Management for our customers. So I'm very much looking forward to the Friday news, as well as the potential inflation news that we're going to get from Jerome Powell, at least their perspective on it on May 1st. So that's coming up as well. As I don't have much else to give the viewers today for free, man.
For free. Yeah, you came in and nailed it, man. We're coming in about 10 minutes short of her usual 45-minute runtime.
No problem. Well, I appreciate the opportunity to be able to deliver this information to you guys. I hope it makes sense. I know we covered a lot of ground there with all kinds of numbers and historical data points. But it is something that you're not seeing in the news, and that's really what we're all about here, is to give you guys the historical precedent that I believe that the news does a poor job of providing. That way
Right.
we can form an asset allocation that makes sense for the type of environment that we are in. And for us and our investors, our allocation really isn't changing, other than the fact that as we get these sell-offs, specifically, in technology and in some of these industrial stocks, we are definitely going to be buying this dip. So looking forward to the rest of earnings season. Very much looking forward to tonight. Hopefully, Bengals get lucky and we get some amazing player just fall in their lap at pick 18, and I would be very excited. If, some
Who
of
are
those
you
players.
hoping for? Like, what do you?
I'm hoping, like, if I get my Christmas wish list,
Yeah.
that somehow, I know that everybody's going to freak out because I get it. I want Joe Burrow to be protected. He is the franchise. For my money, he's the best quarterback in the NFL when he's healthy.
Yeah.
And keeping him healthy is the big question mark. So they did get, a new right tackle on a 1-year deal, veteran, huge guy, really good track record when he's healthy. But I know a lot of people want to tackle because this is a heavy, offensive line kind of draft, and I get all that. And if the great one falls to him, great. I think that they should consider taking him. But if you have Brock Bowers, the tight end from Georgia, and any offensive tackle, I get the positional value there is a potential issue. But this guy's basically, a young Travis Kelce in my eyes.
Yeah.
This guy can line up at receiver. He can line up in tight end. And, I think it'd be a tremendous weapon to have. But you're kind of banking on picking up not potentially as good of an athlete in the later rounds at offensive line and defensive line if you go that route, which I know most people here in Cincinnati just like get big guys up front to keep number 9 upright. I totally get that. Totally on board with that. And I don't think Bowers is going to be there, by the way. I don't think the Bengals are going to trade up to get him. Because like I mentioned, they haven't done that in 25 years. But if I had to choose between one player and any offensive tackle other than maybe like Joe Alt, who will probably be the very first tackle to be taken out of Notre Dame, I'd probably go with Bowers, my friend. How about you?
I mean, it would be amazing if Bowers was left for us to pick up. Yeah, I'd love it. I'm in the conservative camp, protecting Burrow. So it's not
I'm with you
often
guys.
that the draft gets this deep, with O-line and
Yeah, I think it's deep with O-line, wide receivers, and I wouldn't be surprised if Bengals take a corner. So if we got to have 4 picks in the first 97 picks.
oh wow.
Assuming they don't trade in and out. They have 10
Yeah.
total picks, which is crazy. But yeah, the top 100 players are important. They get to pick at 4 of them unless they, again, move around the draft board here. So we'll see. But if they can get a weapon for Burrow, it's called a wideout / tight end, offensive tackle, defensive tackle, and a corner. I'll be like, man, we got it done here. First 4 picks.
That's
Whatever else
A-plus.
happens is kind of gravy after that. So we shall see. I'm excited. I'll be watching, and hope you all get to enjoy it as well. If you have your own opinion about the draft itself, please leave it in the YouTube comments. Love to kind of have that conversation with our audience as well.
Yeah, that'd be great.
All right. Well, appreciate you guys. We'll do this every couple of weeks. So it'll bring us into May, right around Derby time. So we'll be delivering a podcast for you guys in early May again, probably around the 9th, most likely, depending on scheduling, and quarterly review time for me and my customers. So I may or may not be delivering that on the 9th. We'll have to look at the calendars. But every 2 weeks we try to do this, and certainly hope you guys are enjoying this and getting what we're hoping that you're getting out of all this to be a more consistent, profitable investor, at least more informed investor at the very least. So appreciate you guys. Hope you have a great rest of your day. Enjoy the draft. We'll see you in a couple of weeks. Take care.